Donald Trump, for example, who, you know, have a following. And, I mean, I think he's defaulted on numerous occasions, has been through several cycles in the real estate world, and people continue to follow him. But it has nothing to do with real estate. But I remember, I think I said this one a couple of weeks ago, I remember going to Gulfstream Park one day and seeing O.J. Simpson with a friend and a couple of, like, you know, middle-aged ladies. And I thought, haven't these ladies read the newspaper? I mean, no, I mean, you know, you kind of go, you know, so obviously this guy has walked out on a lot of, you know, that. He's not the only developer, I'm not trying to single him out, but he's very active again, and not only on the debt side, but on the equity side, has found a fair number of partners that support him. And so, there are people that understand that real estate, and again, no value judgments here, that real estate is an impersonal business in that sense, and that it translates to the concept of non-recourse on debt, which is, you know, hey, lender be weary or beware, right? You loan, you as a developer put your best efforts forward, and if it doesn't work, hey, you know, just give me the keys and it'll be my problem. Nachi has an interesting perspective, and I'm one of the friends and family that has money into the funds that they've raised, and I like the philosophy of we can't afford to lose money, and they walk a lot away from a lot of deals because I think there's that extra level or layer of caution, which is to say, when you're managing money institutionally, when you're working with other people's money, there's an unpersonal or a dispersonal, you know, aspect to it, right? Which is, well, you put your best face forward, you try, and if it works, great, and if it doesn't work, you know, you move on to another thing. But when you got to face somebody, I had one of my old high school teachers was in town last week, and he came, it was homecoming at school last week, and he came and I had coffee with him on Monday morning. He's a retired school teacher, and when he left LaSalle, he spent 30 years in the public school system, and he's just retired, and he wanted to talk to me about his retirement plan. And we started talking about retirement, and, you know, where do you put your money, and, you know, his thing was, well, what magic formula do you have? I said, you know, I don't have any magic formula, but what I can tell you personally is, when I've made decisions on what to invest or what not to invest in, and I'm advising a boss, it is significantly different than when I'm investing for myself. Or as I said to him, you know, I personally don't have the temperament to assume, you know, the responsibility of advising you on what to spend, you know, on where to invest. I can tell you things you should look for, but I just don't have that temperament, because I can't afford personally to look you in the eye one day and say, man, we lost all your money. You know? Hey, but it was a nice run, wasn't it? And some people don't mind. And some people don't mind. So, anyway, so again, hopefully you found that presentation helpful. I only cut one article out because I asked you all as part of your class assignment today to come up for a couple of minutes and do your spiel. And the only thing that I found that was interesting was from the ICSC newsletter earlier this week. It said retailers, again, I keep thinking there's some sort of paradigm change in how we are buying in this country, and that's ultimately going to impact real estate. But the article focused on the fact that a significant number of retailers are now opening up their sites to pop-up stores. And you guys know what pop-up stores are? Lisa knows. You know?
No.
Okay, so it's a merchant that doesn't really have a physical point of presence, but will rent a place temporarily, you know, to showcase their merchandise and or to sell it. I know some people in Spain. It's my friend's son's girlfriend. Her and her family they were retailers. They had a very high-end store, or several stores in Barcelona. They got wiped out, and the wife is rebranded. She's a designer. She's rebranded. They used to do men's clothing. Now she's doing women's clothing, but they have no point of presence at all. So they travel through the major cities in Europe, and they'll rent a retail establishment for a weekend. Blitz with publicity, advertising, and, you know, people come in and you basically just buy off the rack. Now you can do that on a trade level. It's kind of like a trade show, think about it, but you're doing it on a retail level. And you're starting to see it here. On Lincoln Road last week, I took my niece to Lincoln Road. I hadn't been there in like 2 years. And we're walking and I see a pop-up shoe store. And I saw a lot of vacancies. There's kind of, things have changed there a little bit too. I don't, know that area that well, but it seemed like there was a lot of, it wasn't as full as I would have expected. And some of the restaurants that had been there are gone, but there were vacant locales. But there was a pop-up store there. It was kind of interesting that, retailers are thinking, hey, I can't compete with online stores having a physical presence, but I can temporarily have that, And if I can keep the loyal customer base, I can have them come for a weekend or a month or a week or whatever. So I just thought it was kind of interesting use of space and an interesting evolution. So with that,
health organizations do that as well, right? For like health
for like
sign-up
screenings and things, when there was, I can remember you're saying that when Obamacare, when the whole sort of Affordable Care Act took off, there were several entities that I remember at the Mall of the Americas, the Midway Mall in Miami, there's somebody rented like 4,000 square feet and they had like, it's kind of sleazy like, they had like these fake sort of like state of Florida seals and it looked like it was like an official state agency and it was just like some scummy insurance company, But they had like all these tables set up where, this one time to do it. But they do it also with screenings, come and get your blood pressure checked and sign up at the same time or whatever, so.
Holiday too, seasonal.
Seasonal, well, I mean, the traditional pop-up stores are the fireworks places, right, on the 4th of July, right? Yeah. Right before New Year's, or the Christmas tree, right, or the pumpkins now, right?
Yeah.
So those are, but now they're sort of taking a hold in line, at least from what this article was saying, So with that, I will take whatever order or sequence you guys would like to follow, so just come on up, tell us who you are. You have no more than 5 minutes. If you don't have 2, that's bad, but no more than 5, okay? No more than 5, because we got to so.
Hi, I'm Frederick Jackson. My article was from GlobeStreet.com. It's by Jennifer LeClaire, October 6, 2014. The article is very intriguing. I know the class is about due diligence. This particular building is a Chase Bank building on Alton Road in Miami Beach. It's 20,000 square feet. There's 2 tenants in the building. You have Chase at the bottom of the building with the drive-through. Upstairs you have Social Security Administration Office. It's 2 great tenants. What I found intriguing about the building was the person who purchased the building paid $800.
Robert, look at your audience.
Huh?
Look at your audience.
Okay. The person who purchased the building paid $800,000 more. They bid it $800,000 over the asking, and they did not do a due diligence on this building at all. So I thought it was kind of intriguing how we talk about due diligence, and these people actually paid more for the building without even checking the building out. So, I mean, the speaker this morning did such a great job on it, but I was thinking of some things, pitfalls that might happen if you do not do due diligence on a building. And we kind of know them now in the class. The physical aspect of the building. Some of the things I was thinking about to buy a building like this, how could you do that without knowing the roof, the plumbing, the situation of the physical aspect of the building. Not checking the rent roll, anything like that. You don't know when the leases are up. It's horrible, horrible. Also, I talked about estoppel letters. You don't know, you can't judge the tenement of the tenants. You don't know if they're pissed off, they're gonna leave, anything like that. And also, it would probably affect the value. How can you value the building properly without doing due diligence?
Okay.
Yeah. So that was basically it.
Good. That's what we that's what we're here. So next, somebody come up. I just gotta find my phone somewhere. Here it is, so I can time you. Just before you start, as you're setting up, the issue is typically, just so that you know, and it's no due diligence doesn't typically mean no due diligence. Typically, it means a seller's giving you a package, and you're not
challenged it.
You're not digging into it. So you would typically either take their underwriting or take their underwriting and make your own assumptions. And so you're not going to go there. They'll give you a property report. You know, you won't be able to interview tenants, but you'll know lease terms. You'll know NOI.
Oh, you'll notice stuff.
Yeah. So you're not going totally naked. Okay. Just half naked.
Okay, my article is about, I got it right during the week when the stock took a big hit, dated on Thursday, October 16th. Basically what it talked about was how banks and their inability to see how the interest rates have been very limited, that they can't get the spread that they're looking at to become profitable. Now, how I read the article and I looked into it, I saw it more for the due diligence in this class that we are in about the financing aspect of commercial real estate. So as you see that the rates haven't gone to what we thought they were to continue to increase, that leaves more opportunity for possibly leveraging assets more if you can expect good returns. So that allows for a higher leverage and getting higher returns. Also, the ability to potentially refinance as rates continue to stay where they're at now. So though the big banks and their stockholders aren't getting one of the returns that they wanted, as a due diligence side, I see it kind of as a positive. What we thought maybe 2015, the first quarter, the rates would start to increase. They're now projecting that to be further down, and the volatility still allows people to obtain financing at a very low cost of debt, therefore being able to potentially leverage the assets and get higher returns. So that's kind of how I read it, and it was an interesting time of the article to come out as the stock market and treasury rates were plummeting.
But Michael, if interest rates go down, what happens to cap rates?
The cap rates would go. Interest rates would go down. You would see that the cap rates would also compress as well.
So there's no real benefit then. I mean, if the price you have to pay for real estate goes up and the cost of debt goes down, I mean, don't they just offset?
They would. I mean, unless there's a time where the compression isn't at the exact same moment. So there's an option as it's not going to increase just as fast as the real estate.
Okay, so it's not as simple as
No.
it's not just as simple as the cost of capital goes down. And so it's time to pile on the debt, right?
Right, but if you can expect still good returns, it might be an option.
Okay. All right, thank you very much, very good.
Good.
Okay. My name's Dustin Anderson. My article's on techno music. Who likes techno?
What is techno?
Techno's like ding, 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 ding.
Requires a lot of alcohol.
So, techno music was actually created in Detroit.
Oh, you
and
serious?
in the late 80s, a bunch of people from Berlin picked it up, and now Berlin is the capital of the entire world for techno music. So a bunch of people from Berlin are now coming back to Detroit, and they want to take these old decrepit buildings and turn it into the capital of the techno world here. So the article just talks about how they're doing their due diligence, and they're going and talking around to the city council, the mayor, and they're getting support from all these government officials in the local market to be able to take these buildings that are abandoned, no one's in them, a lot of them have environmental issues, to turn them into a techno nightclub and make a whole scene. So that's my story.
Just one or a couple of them?
Well, it's blocks.
Oh, okay.
I mean, in Detroit, apparently, it's like a sea of just vacant buildings.
So what you're saying is that you're focusing on the importance of meeting with local planning and zoning officials and garnering local government support for alternative uses or changes of uses or economic incentives or anything else that might support or give credence to your acquisition.
Right, and they're more looking at it for, I would say, the change of use. Because, I mean, really, Detroit is, and I mean, huge manufacturers are completely out of business. They have buildings, 400,000 square foot buildings just empty, block after block after block.
Mm-hmm.
So they're looking to, the gentleman that wants to get this going, he is like the godfather of techno clubs and the redevelopment in Berlin. So he's coming over here and he wants to take large swaths of these land and convert it. So yeah, obviously you need, the government. He wasn't necessarily looking for economic incentive. I don't think Detroit has much to offer as far as that part.
At least they support. A lot of times, No, the importance is a lot of times part of your diligence is either getting a land use changed or just the encouragement of local officials. Hey, we'll build that road out to there. Or, yeah, we'll work with you in, creating an empowerment zone or whatever. So part of diligence is meeting with local officials, so.
And the best thing about this article is when I was reading it, just because I was reading the paper and I saw technology, I was like, ah, this looks interesting. But then there was a hidden real estate, story in here, and it wasn't. The headline wasn't real estate; it was about techno music.
And you just read it because of that?
Oh, that's good, man.
Yeah, it's good. You don't read
He's
the whole
into
paper.
techno.
He likes techno.
So excellent. The only problem is with nobody working in Detroit.
Who's going to the club?
But that's neither here nor there.
Maybe they take the drugs.
Oh, okay, they they'll have a manufacturing thing for,
Boom.
there we
Make
go.
them feel better.
I need somebody, let's go.
Boom.
All right, hey. So, my article is titled Real Estate Investment Risk in Asia and Latin America. So,
What article was this?
it's a real estate investment risk in Asia and Latin America. I got it from corporatesecretary.com. It's the author is RD Majar. It was printed April 11, 2012.
Keep going, wow.
All right, so investing overseas for companies usually is they like it because it usually diversifies their portfolio. The due diligence process that goes behind it is actually falls in the hands of the corporate secretary of the company or the general counsel.
Okay, your audience.
The main source of my article is called Rodolfo Rivera. He's a regional counsel at FNF Title International. FNF Title International is Fidelity National Financial, which are leading providers of title mortgages, of title insurance, and mortgage services here in the United States. He goes on to say that companies usually like to invest in the countries that are classified as BRIC, which are Brazil, Russia, India, and China. This is because they were the least affected by that financial meltdown. He goes to say, and I quote, real estate was not sold at inflated prices, and banks were not lending at 100% equity in those countries. So acquiring a real estate property outside of the U.S. usually requires property transfers, and registration depends on various common laws and civil jurisdictions. Some problems that arise from doing this here in the U.S. and outside, but more outside because the governance professionals usually don't know what they're dealing with in those countries are fraud, title transfer issues, invalidity of documents, erroneous or inadequate description of property, survey violation, or unenforceable mortgages. He goes on to give an example of a property they bought in Costa Rica, where some Costa Rican notaries actually participating in falsification of deeds, and this ended up for the investor. They ended up not being able to build because they actually owned less of the land than what they thought. So, another problem that also the article talks about is a perspective of easements, which we actually touched upon with our speaker before. He goes on to give another example of a purchase they made in Mexico, where they did some adjustments to the building, and it ended up happening that a utility company had the perspective of easement of that property, and they ended up having to spend $16,000 more than expected. The second source in my article is Mr. David Allen Talley, who is a global counsel for Panasonic Eco Solutions. He actually participated in one of the biggest deals from a Japanese company to an Indian company when acquiring 80% of when Matsushita Electric Works acquired 80% of Anchor Electrical shares. While doing this deal, he actually partnered with an Indian consultant, and this actually made the deal much smoother. He goes on to say that this is one of the main things that we have to focus on when making deals overseas, is actually having somebody that knows how everything goes over there. It's really important. He also talks about bribery, and I quote when he says, "It's hard to tell if a title or a license was legally obtained, and accessing previous records takes time. Sometimes to avoid transfer tax and fees. Properties in India," in this example he talks about India, properties in India will change hands for 4 to 5 times without ever being recorded. So, that's something that happens a lot overseas. Here in the United States, I guess, laws are applied better, although you do see these type of problems sometimes, but you see it more overseas. Another thing that they talk about that I thought was interesting is how you have to look over legal opinions, because legal opinions are just that, and they really depend on the quality of the partner that you're dealing with, and they also depend on the customs that are practiced in that country. How to overlook these legal opinions, or how to go over these legal opinions, you always have to ask, and Rivera says that you always have to ask for the documentation. So basically, if they say that a mortgage is paid for, go ahead and attach a satisfied promissory note that certifies that mortgage is paid for. And also, a really important thing that they talk about is how it's really beneficial to have a relationship with government officials. If you do so, they'll probably get you through the loopholes much better than if you don't. So that was basically it.
Okay, very good. 5 minutes are up. Listen, internationally, you have just as much of an obligation to look at or due diligence when you acquire an asset. With the added complication, as you mentioned, that we don't typically see the same level of legal transparency, sophistication of property records, enforceability of laws, integrity of judicial systems, et cetera. So, just buyer beware in a lot of these countries. And then not to mention business practices, which you talk to bribery and all that, and the whole aspect of currency risk, which we won't get into at all, but, so, buyer beware. Next.
My name is Alyssa Schachter. My article was in Miami Today. It's on the industrial vacancies and trends with that. It sort of started with, how there's different opportunities and industrial can be built, more quickly. So the populating of industrial sites is, there's not as much that can be built spec-wise and then, go vacant, which is nice because it takes more or less a year to build out rather than some of the other sites. And it talked about how e-commerce is driving this because, whereas bookstores used to take up a lot of space in retail shopping centers, now, like we were talking about earlier, Amazon, which just did one of the biggest leases in Miami, it was like 350 square feet of space, actually near the site that our case study is based off of. They're taking up a lot of the industrial space. So the new trends are that a lot of these industrial spaces are being built to suit. Vacancy is going down because the demand for industrial space is going up. What else was there? And so because of this, there's over 2 million square feet of industrial space that is spec to be built in Doral, Airport West, and Medley in the coming year. So that's the trend.
Okay, so the moral of the story is know your market, right? As part of diligence, understand your market. If you're looking for industrial, if you guys are going to do diligence on a project you're working on in your other class, then you need to realize that if DTC is going to build, I don't know what it was, 600,000 square feet, is that what they're building? You don't even know, okay. This shows how much you look at it. Glad you're not in my class for that. What did he say?
man.
Glad I'm not on his
She's
team.
doing
Really,
a phenomenal
Dustin?
job, right?
416,400.
Okay, so if you're advising somebody who's building 400,000 square feet, and there's 2 million coming online, well, what's the size of the market, right? How big is the industrial market in Airport West and Doral? Is Medley really a competitive market? And what happens when you dump 20% or 10% of new product into the market? What's going to happen to the rent? So, thank you. Next.
Yeah.
I know, right? It's like Family Feud.
Family Guy. You're there. You're almost there. I got an article from the Wall Street Journal.
Introduce yourself.
Tyler Kitson. I found a really good article that related back to what we did last class in relation to different markets and vacancy rates, things like that. This article really focused on a 527,000 square foot building in Stamford that's looking to restructure their debt. The owners are the Landis Group.
You might be familiar with them. They, or maybe not, but they own part of the Vikings. Anyway, what's great about what they're doing is they're looking forward in the future, and they're realizing that there are a lot of issues that are going on with the market right now that are causing them to kind of reconsider what they're going to be doing later on. One, their office rents are going down. I think almost $1 in the past quarter, $47.54 in the fourth quarter of 2013, and $46.64 in the second quarter of 2014.
Which article is this? You didn't identify.
Oh, sorry, Stanford Tower Fields office market drag. They're comparing the markets from Stanford to Stanford, Connecticut to Manhattan. What's happening is Manhattan is Stanford.
Not Stanford like California.
No, Stanford, Connecticut, and Manhattan. Yeah, Manhattan is really taking away from Stanford's office market, and it's really going over this. They really focused in on this one building. Also, the vacancy rates in Stanford are rising compared to Manhattan. They're at 27.9% vacancy rate, while Manhattan Midtown is 8.2%, and the rest is around 11-10% of vacancy rate. Not only that, but they're realizing that the rest of their tenants are going to be moving out within the next couple of years. They have two major tenants, UBS and Paper, International Paper. Yeah, International Paper, which both leases are ending up soon, and they're all looking actually to consolidate within and move their people into Manhattan, which is also continuing to take away from the market. So after reading this article, it really kind of went back to what we did last week or 2 weeks ago, I should say, and really shows that if you can look into the future, I mean, with the market analysis, you can really figure out what's going on and prepare yourself, which is good.
So again, the takeaway there is understand your markets, understand the competing markets, understand the underlying market trends. People used to go to Connecticut because Connecticut was a great place to do business.
What was the vacancy rate?
27%.
27.9, yeah.
How do you buy an office building with two large tenants leaving the market and 30% vacancy? I mean, you got to believe in something. You got to believe in something, or you got to know something. You got to reposition something, because that's a tough order to fill. So, okay, thank you. Yes.
Good afternoon. My name is Marielle De Pena, and my article is on multifamily from the Daily Business Journal. The title is "Looking for Investments in Real Estate. Fort Lauderdale is the place." And I don't really care too much about the data that they provided in the article. More so, I was intrigued by the article because of who posted the article in their LinkedIn profile, which was Styles Construction. And we sat down with Terry Styles earlier in our evolution here at Nova, and he says that there was too much competition with the multifamily, entering into multifamily as a developer. So I thought it was interesting that they would post that investors should go into multifamily, and they say multifamily, but they're really pitching student housing. And then they go on to say that the major developers have started to take note, anticipating rising demand for young workers. So why would they spend all this time to tell us about how multifamily and student housing is a good investment and not address the trend? The trend is that they're anticipating the young workforce actually going into working. And then that had me thinking, what is Styles doing? And then they have two luxury style developments here in downtown. They did that one plantation over there by Davie, which is near the main campus. And I actually got assigned to do a multifamily feasibility in our last market analysis class for Styles that was in Coral Gables. So why would they post this? And I think the big takeaway for me is that you have a whole bunch of market analysis reports flying around, and then like how we spoke of, the brokers always want to pitch you the best deal, but you have to dig into it. So they provided a Realty Track is their source for the market trend, but really it's just opinionated and it really doesn't have any weight. And so that was something that I was speculative on.
Okay, and the link to the diligence class is?
The fact that the market analysis reports, you have to actually dig into it and actually find out what's going on in your market. It's like how you said, you have to know your market. So, another takeaway.
Okay. Next. I don't need a copy of it. I didn't ask for it.
Okay, sorry.
Don't kill trees.
Don't get it.
I'm an environmentalist.
All of a sudden
Since when?
I don't look like one?
today.
I didn't realize you and Frederick have on somewhat matching
Oh,
shirts.
don't stop it.
They both fancy.
That's why you noticed. Okay, my article came from the Wall Street Journal, and the title of the article was U.S. Banks and Activists Clash Over Due Diligence Proposal. What's happening is that the U.S. Treasury wants banks to really check into the identities of the people who they're doing business with. So it's everybody, meaning whatever business you're doing with the bank, they have to make sure that you are an actual person, and they have to make sure that they know what activities you're involved in completely. So you're not a shell company, you're not a fake individual. They actually check you and they actually have your information on file. Now the problem arises when they're trying to figure out whether or not it should apply to existing customers. So activists are saying it doesn't make sense for it to apply to existing customers because it's going to cost too much for the banks, it's going to take too long, and it's just going to be an exhaustive process. But then the persons on the other side are saying that it's not fair to apply it to the new people if we're not applying it to the existing, because then it wouldn't mitigate any of the facts. Now how that applies to the diligence class is, I was looking at it from the young lady who came 2 weeks ago. She told us about it from a finance perspective. Claudia. She told us about it from a financing perspective and how they look at the different clients and try to assess whether or not you can trust the clients or whether or not you want to get into business with them. So that's why I looked at it from that perspective, because in our business, most of our financing comes from the big banks. And if they start going through this process, how many people will actually end up being weeded out? Because we don't know some of the people that we necessarily get into business with. And that was pretty much it.
Okay, so it's know your customer, right? But more important, know your bank, or let your bank know you.
They did something similar thanks to the Anti-Money Laundering Act in Jamaica, and they have a proposed compromise in here that they're saying they could start it with new accounts from X date going forward, from the date the act comes into play going forward, and then if you come in for a new transaction, then they could do it that way, but that's still being reviewed.
Okay, so, thank you. The real issue here is, the Bank Secrecy Act requires you to know your customer. And so, for you to do any business with a bank, they gotta go through your shorts and figure out who you are and your source of funds and all that. And there's a big to-do as to what do you do with people you previously had relationships with, do the laws apply or not, so, thank you.
Can I use a computer?
You may, but why don't somebody else go up while you're setting it, because it takes like 10 minutes to get that set up. Somebody go and,
That's easy. Go. Ready? Oh.
This was just for US banks?
You can look at it if you want.
Stop killing
Since he
trees.
doesn't want it. It's one copy.
All right. So I picked an article from globestreet.com, and same author.
you are?
Alex Gulick, and the author of the article is Jennifer LeClaire. And the article's title is Related Spends $57 million on a Downtown Site. And the reason I picked this article was because I frequently read through globestreet.com and find different deals, and they don't always break out the due diligence behind it or anything that goes there. So just to give you an idea of what I read, I'm going to give you just the facts from the article, and then I'm going to give you kind of a thought process behind it, is what, and how it relates to due diligence. The article is from, Related Group did a $57 million land acquisition on 2.8 acres, and it's located like east Miami, right between downtown Miami, Wynwood District, Design District, and Edgewater. So it's really linking all of those communities now that are really starting to be developed. And the site itself is going to be 2 million square feet of luxury residential units and ground floor retail. and it's going to have water views on both sides and then city views. And it's creating a culture around museums, because you have the Pan Museum and the Frost Museum right there. So the owner of Related Group is George Perez, who Miguel had mentioned before, and he had started his career back in 1979 doing multifamily and apartment and condos, and then had subsequently gone under, and now he's back doing a ton of projects. And so that's really the summary of the articles, how his project's going to be so great. What's going through my mind is, these following due diligence items. How's the site going to work? As far as due diligence, is the zoning there, the parking, the height restrictions, environmental issues, geotech issues, all those things, is it really going to sustain and be able to support this condo project that he has? As far as the 2 million square feet of residential and retail, does the market, with the demand and supply and net absorption, does that really get factored in? Is it going to work? Are they going to be able to sell those units? Are they going to be able to lease up that space? Going along those lines, does the underwriting behind this deal support it? Does it need to be supported because maybe he can go to any bank and get a loan? So when I look at that, I think of the development costs for a project for 2 million square feet. Does he consider the impact fees associated with it, the rising costs in construction? What is his exit price on these condos, and is it something that's pre-sold, or how is he doing it? Because it's a huge project, and when you look at the rental rates, is it really going to support in that area X amount of dollars? Is he going to keep that because it's part of a condo, or does he manage that out? Like I want an article that would break down, almost like a click here for details. So these are the further things that I was wondering about. And I don't know if anyone's heard about, but how these condo projects are being financed. So he may not be at risk for the money. It may be 50%, 60% pre-sold, and then as the construction starts, it's another 10%, and then as midway through, it's another 10%. So by the time it's done, it's all profit to him. And that the article obviously doesn't go into that either, but that's one thing that I would like to know is how is this massive project being financed, and if it's not being financed through that kind of deposit structure, is it how does a bank look at the Related Group or George Perez as a borrower? Because right now, the article at the bottom also mentioned he has 6 other projects going on right now that are multifamily that it had listed. SLS Brickell, Hyde Midtown, SLS Luxury starts this fall, Hyde Resort and Residence, and 2 other towers planned to break ground in November. So that's a lot of projects and a lot of risk. And he walked away. He had said, $400 million in debt. How do different lenders assess him as a risk? So that's really it. It was more of a my thought process when I read these. Developer does another deal. Like, how's he doing it? What's the thought behind it? Where's the support? And the takeaway is, I would like to be able to get that kind of better relationship drawn when you read an article like this, to know that, oh, it is going to work. That retail is doing really well down there, and the demand for condos are still really strongly supported there. So he probably has something pretty good. But that was it.
All right, Daryl, start setting up while I just finish on that. Thank you. The problem is you're never going to get that anywhere.
No, I know.
So you always want to know what everybody else is doing, but that's always private information, and those are all very good questions. So at the end of the day, is how does it pencil out? When you see an article that says, I'm paying $57 million for 2 acres of land, how does that work? So you had sent me.
I started doing the math, and I was like,
yeah, I don't know how that works, but obviously somebody's doing it. You said this particular guy's got, you said 60 acres, he's got a joint venture with Terra Group in the Grove, on the old Coconut Grove Bank site. These kids in Spain sent me an article the other day where he supposedly paid 120 million euros for something there. And my experience with it has always been other people's money, and he doesn't sign anything personally. So anyway, wow, you've gone like, whoa, high tech.
His first project had to come
Well,
prepared.
let's go.
Right. So my article is Starwood Time Bomb closed $1.4 billion hotel deal by Erica Murphy, and it's from Globe Street. Article basically states Starwood has began shifting its focus from the hotel market to the retail market. You know, they're always been known for their modern technology in their hotels. They provide like the luxury experience. Now they're buying a bunch of retail stores in affluent neighborhoods, going into the more ritzier market. And this company was just started 2 years ago. It's a subsidiary of Starwood Capital Group, which is the manager and people who own and run the hotels. Its first major acquisition was in spring 2013 when it acquired Blue Black Square in Hartford, Connecticut. It's a mixed retail use destination. Like I said, it's in an affluent neighborhood, so they're targeting specific markets. Today, it recently acquired majority interest in seven regional shopping malls across the U.S. One that sticks out is the Mall of Wellington Green here in Wellington, Florida. The total sale for the 7 retail centers was $1.403 billion. Net cash is $736,623,000 in debt and $44 million in transaction costs. To take on that amount of debt, it seems to me that they have researched and done diligence, and they know exactly what they're marketing for, and the group that they're marketing towards will eventually be profitable for them. According to the RSI, or Relative Strength Index, Starwood fell into the oversold territory for their hotel side, and that's considered when you go under 30. Today, Starwood is at 29.8. Starwood is acquiring assets to move its money. The hotel market is on the rise, according to sources. To me, I'm just trying to figure out why exactly are they shifting from this if it is said that the hotel market is on the rise. Well, that says to me that it's a lot of competition coming in. I found that over 400,000 new hotels are under construction across America. So with the competition soaring and being so high, they're looking to move their money into other markets.
Okay, you done?
Yeah.
Okay, so, very good summary, and then probably more in depth than we needed, but that's good. So just leave that slide there for a second, because
This one?
I think, no, the next one. Next one. I think you're saying RSI, and you're talking about HOT, I think is the
symbol for
Starwood hotels, right? So, and there's a lot of different takeaways from here. One takeaway from this is, look at the transaction costs. You can say, wow, it's a pittance, right? It's a pittance on a $1 billion transaction, but you can tell, I don't know what goes into those. There may be debt prepayment fees, there may be brokerage fees, or maybe, God knows what there is there, okay? But you can see that diligence costs can be pretty significant, okay? Another thing that you can kind of look into, from a diligence perspective, you could say, anybody can go into any real estate business as long as you got money and you can do diligence. So you got a company that's an asset management firm that's always specialized in hotels, and all of a sudden they're transitioning into retail. And as long as you got money and you know how to investigate, you can do anything. So anyway, thank you.
What is RSI?
Relative strength.
Yeah, that's a technical. I'm not. Look, Dylan. Why don't you give them a technical analysis class out there? It's voodoo. It's voodoo stuff. We get stuff like that, yeah.
It's voodoo.
It's voodoo. I don't know what's about that. We got another.
Listen, I apologize, number one. I keep following this up. But Dylan didn't look like he was about to get up, so I just figured I'd do it. Overall, my name is Robert Stone. I didn't even print out the article, so I feel bad, or whatever.
Did you read it?
Yeah, I did read it at some point. Can we turn this off? All right. Well, again, hi, guys. My name is Robert Saunders. I don't need the lights. I'm good without it.
Well,
But thanks anyway. Appreciate it. Good guy. Good guy. Anyway, the article I read came out of the Business Wire. It was labeled "Teo, big retailers move in as West Texas population explodes." Essentially, it was, well, the first thing that popped up about it was that Walmart is actually, they just got a, let me see what it says exactly. They got a zoning change which cleared the way for them to throw out some Walmart Expresses out in a little town called Merkel, Texas, which literally is just over about 2,600 people in this town. So essentially, the reason that they're moving into this small location is because it's right next to Abilene, Texas, which is pretty much the region's largest economic center. The reason being, you may ask, is why is everybody moving to Texas? This is a question a lot of us may have asked last semester with Jesse, our class in the market analysis. Why is everybody going to Texas? Essentially, the reason is oil boom. Everybody's moving to Texas because there's an oil boom out there, and it doesn't seem like it's slowing down at all. So now, big retailers are starting to move into the area to try to they're basically suggesting that, all right, boom, the population is growing, the business is growing, so we need to be there. So a company like Teo, which is actually Taylor Consultant Inc., they actually created what was called the Third Avenue Development LLC. It's just like not necessarily a shell company, but a real estate investment company just for the sole purpose of acquiring land out in the Texas region, over in the West Texas region. The CEO of Teo, who is Scott Wheeler, he goes in and says, well, Walmart is moving into this area for the same reasons we are. This area is booming. It's not about to stop. The oil is going. It's not going to stop anytime soon. So right now is the time to acquire land and start getting this development going. Just a couple of facts about what they've done so far. They've acquired 2 properties, and this is Third Avenue Development I'm talking about. They've acquired two properties in the Merkel area, about pretty much like a 1-acre lot and a storage facility, but they've actually begun the due diligence on a potential acquisition of a 10-acre property in the area. Just that's a potential acquisition. And then they've also targeted large bulk properties, and they even went on to acquire a real estate brokerage firm, a firm, just to help ease the process of purchasing these groups. So pretty much in a due diligence thing, it's just, all right, it can't be just because the retailers are coming into town. That can't be why, as a company, you're going out and putting all this money into these areas. You actually still do need to do your due diligence. Now, again, it's an article, so they're not going to give you the nitty-gritty of what they did to make a decision. However, you can assume, or you should assume, that they are actually going out there to do some good due diligence before they spend all this money in these areas. Any questions? Didn't think so. Thanks.
Really?
I gotta use the bathroom, actually. Actually, I'll wait for Dylan.
So you gonna turn around?
Come on, stop trying to set me up, man.
John, I'm getting tired, man.
You going paperless?
Yeah.
Paperless.
Dylan Siegel, and my article was from globestreet.com, and it was called Office Sector Gains a Global Yardstick. And what basically does that mean is they're trying to develop a universal way to measure office space and the square footage involved in rooms like this. And as Nachi, the speaker, kind of put it, there's a lot of inconsistencies and discrepancies in how you can measure a space. And obviously that leads to a lot of buyers coming in and trying to buy it, maybe that it's underutilized, but you know, for the due diligence process, if this takes hold, the author's viewpoint was that it should increase demand for office space. I don't know if any of you guys see that as well. I didn't really see where, I mean, understanding that maybe it's a little bit more clear, you know, you can maybe get some guys more interested in purchasing office space. I don't know really how he came to that conclusion so concretely, but basically they're trying to develop a universal way to measure office space. BOMA is involved, IMF is involved. So, you know, as the title says, they're trying to gain a global yardstick and how to measure these office spaces universally. So it may increase investment, I'm not sure. Time will tell once that's actually laid out, but they're in the process of coming up with a way to just basically, for example, what Nachi pointed out, sometimes you have these vertical comps that aren't included sometimes. Some guys do include that. The article gave an example where an office space user was looking for office space to fill 100 employees. And after getting their office space, which is what they thought could fit that, turns out there were columns here and there, and it wasn't included. And all of a sudden, they can only fit 80 employees. So apparently it's a problem, and this is their way of trying to fix that. So that's what my article is about.
Just to chime in on what you were saying, it could be because once they remeasure these places, they will grow. So that money that you're getting, if you keep the rent the same, you'll get more money for it. So that may grow the demand because now you're getting more money for the same space.
But in many cases, like Nachi pointed out, it can go the other way.
You're small, yeah.
So, I mean, putting a universal thing, they claim that it will increase office demand.
Yeah, I think the rationale there, at the end of the day, is real estate, as I've said before, is a price volume business. So if the price is constant, but I can increase the volume, then I'm going to get more revenue. So it probably sounds like a broker's trying to, you know,
Yeah.
Sell you something.
sell you a concept of, hey, buy something because you're going to get more income than they're really saying, because if you remeasure this, you know, you'll find a way to get, he got more income. I mean, I think that's what the article is trying to allude to.
Well, I mean, BOMA's involved, and, you know, they already have their ways of measurement that's widely used. So, I mean, IMF is involved, so, I mean, it's a global thing they're trying to, you know, put out there. So, see.
Make sure like a Jamaican.
It,
Should be.
if there is a suggestion just to make on the presentations is, you know, I thought the instructions clearly asked for a link between the article and diligence. And I think they all had it, but I think from a speaking perspective, some of you just sort of ran off with the real estate, you know, implications and not necessarily the diligence implications. So all valid articles. At the end of the day, as I've said, almost every business, well, every business has to operate in real estate, so you can almost always draw a link between real estate and any business story. And in particular, where there's a transaction involved, there has to be an implication of investigation, negotiation, interpretation, right? So that's, if there's a recommendation to the audience, is when you speak, try to draw a link between the instructions and what the article is all about. Yep.
Those presentations are graded, correct?
I'm sorry?
Are those graded?
Did you read my instructions?
I can't remember.
The instructions clearly say that
I'm old.
the assignment, which will be graded, of course.
Are pigs pink?
Or what?
Pigs pink.
Not all.
Not all pigs.
Oh, yeah.
No, not at all. Not at all.
They're
Right.
white.
You can draw the link.
Oh,
Not all
shit, they-
pigs in the island are pink.
Frankly, you can draw the link, as I said.
Everywhere.
You know, I think all the articles in one way or
It's
another
black pigs.
had the ability to draw that link. It's just not that everyone necessarily dragged that link as clearly. we're going to do two different things in what is the remainder of the afternoon. One, I'm going to spend about 15 minutes only looking at a lease and looking at a lease abstract. And then you will, on your own, I've broken you up into groups. Some of you received an email from me during the week. One of you who did is not here. So that's kind of a downer, but you're going to have to reach out to him. but you will need to work, and you can do it any way you want to, on actually taking a lease and abstracting it yourself. Okay, so, you know, ultimately, reading a lease and understanding, you know, what kind of revenue stream do we expect from this, and what, you know, since Nachi was saying before, what other conditions related to rights or obligations associated with that lease, termination rights, expansion rights, renewal rights, shrinking rights, etc. You may have parking spaces, etc., TI allowances, or whatever. So you'll have an opportunity to hands-on abstract the lease on your own. Okay, so say, how do you abstract a lease?
Show us.
Well, with a fair bit of time on your hands, hopefully, and you know, a lot of patience, and enough of Jacksonville. I'm not feeling nostalgic anymore.
Oh, I'm sorry, man.
Sorry.
I'm excited. I'm ready to go. Front seat. Never
Front
been
seat.
closer.
That's gonna be your permanent seat.
I don't think so.
Next week we want to see you there, man.
We're gonna move you to the front of the class
Oh, man.
every week.
It's cool up
It's
here.
your new assigned seat.
Yeah, you actually fit in pretty nicely up here. It's easier to
See?
pick on you.
I know, right?
Professor's assigning you that seat permanently.
Oh, thank you.
So happy to have you.
So, as I mentioned, the fund that Glenn works for recently purchased a building at 901 Ponce, which is a street in Coral Gables. It's one of the major business streets in Coral Gables. They purchased an office building there. And he was kind enough to share with me their entire due diligence folder. And so one of the subfolders in that is all the leases and a lease abstract. So I just said, let's go in alphabetical order, and let's just grab a lease. It's a small world, you know, Miami's a small town, so there's actually a lease related to a girl I went to high school with. She's an architect, and she happens to have her office
Oh, wow.
in
Sweet.
this building. So, I'm sorry?
C3TS?
C3TS. No. Yegas Architect. It's a small firm. So,
It's nice.
I'm gonna hold on, before I get there, I wanna show you something that, I think is important, and that is, in almost any real estate asset, you wanna have a form lease. And one of the things you wanna look at is what form lease is in place. Ideally, over the life of an asset, the form lease hasn't changed. And you're gonna say, what's a form lease? Well, the form lease is exactly that. It's a document that the owner of an asset puts together and tells its prospective tenants, this is the lease that you will sign. And hopefully you don't deviate from it. Or you don't deviate from it significantly. Because just stop to think on one concept, what Nachi was talking about this morning, where imagine that in a multi-tenant building where you've got 70 tenants or 50 tenants, you've got some that have triple net structures, some that have modified gross, some that have full service type leases. Imagine trying to calculate operating expense, pass-throughs every year, or common area charges every year. This tenant's got this base, that tenant's got that base. It's hard to get your hands around, right? Imagine that you've had several institutional owners over time, and you've got 3 or 4 different concepts of form leases in place. How much more difficult it is to try to understand. Guys, hey, I know it's really distracting. It's really distracting for me to speak if you guys are working on computers and cell phones. So I ask, please, that's the only thing I ask for in this class. I can't focus. Other people can do it, I can't. I apologize.
Form leases.
Yeah, I'll get there.
Okay.
So how difficult it is to get your hands around if, particular form lease, for instance, permits subletting. Another one doesn't, or another one does, but, profits go back to the landlord. So ideally, most institutions have the same concerns. Most institutions, while the form lease may not be exact, even if there's been several institutional owners over time, there won't be significant modifications to the conditions or the terms in a form lease. This happens to be the form lease in this building. Apparently this building was owned by the same group of 25 individuals for a very long period of time. So when Glenn's group comes in to look at the diligence or due diligence, most of the leases are at least going to be on the same form, which is going to make the review that much easier. So then you can focus on the important economic items: space, right, term, rates, right, and then some of the deviations that you may have on some of the rights. But so as you can see, it's just the form where you focus on all of the specific items, okay, signage, etc., parking spaces, but any building should have a form lease agreement, which should be the base that you start with, and you should not deviate from it significantly. I would tell you, in most institutional owned real estate, people will not deviate. They'll say, take it or leave it, okay? Yes, sir.
Now, when you actually purchase a building, do you come in with your own form lease,
Well,
or you accept what's there?
No, what you'll do is you'll take your lease to your attorney, or the form lease that's in place, and they'll look through it, and they'll make small modifications, or they'll tell you, listen, it's okay, go with that, and then, they'll just negotiate every time somebody comes in. You'll say, listen, we're not going to change the form, but we don't particularly like that when we send it out. We'll be careful with what changes come back from from a tenant. We'll either tell you to change it or not. But hopefully, the material components of the lease are constant from one owner to another, and your attorney should ideally not have significant deviations from what another attorney has put together. I ran, as I mentioned, the trade zone in Miami. We owned it with an institution. We owned it with Prudential. It had been owned by a family. They built it, and their leases were not institutional in nature. We came in and we significantly modified the structure of the lease, and that became very difficult to negotiate with tenants that had been there a long time. When their renewals came up, and they were accustomed to looking at a particular lease that was more mom and pop and didn't have some of the restrictions that an institutional one had, and they're like, well, wait a minute, we didn't used to have to do this. It was a lot different environment, but we changed it outright. We just couldn't work around what was there. Our attorneys couldn't work around what was there. Okay? So again, to the extent that when you come in, there have been multiple owners or multiple form leases, it might make your review that much more difficult. Okay? Now, so we get down I'm going to shortcut. I kind of jumped through these the other day. And, basically, I'm not going to go through, for purposes of the class, going through the original lease, the first modification, the second modification. I just jumped to the most recent modification, which is signed on the 11th of July, and it's a 3-year term, right? The original lease was 2003, 1,700 square feet, right? Volume, 1,700 square feet, and we got to find a price, right? Got to find a price, and here are the rates, right? So much per year, so much per month. It's already got the bumps in there, okay? What are all the other important conditions? 3 months free rent, right? 3-year renewal. You can apply it whenever. There's also some TI allowances here that are being allowed. You'll have up to $8,000, okay, that you can utilize for the space, primarily paint and carpet and anything else you could. What should paint and carpet cost you in an office building? Dustin, you're a contractor.
$1 square foot.
$1? That cheap?
What should what cost?
Paint and carpet.
Oh, carpet.
Yeah, no.
$1 to paint the walls and $1 for the carpet.
Wow, I'm hiring you next time. It's probably a little bit more than that. I'd say somewhere between 5 and 10, but if you can do it for that cheap, awesome. I find a new supplier.
He's a man. That's the
He's
man.
the man.
You got a business card.
Some of the other issues that Nachi was talking about, which tend to cause problems with multi-tenant buildings, parking spaces. So in this particular situation, she gets 5 parking spaces. What is typical parking ratio in an office building? 4 to 1? In a downtown office building?
You don't get that much. 2 to 1.
It's 2 to 1.
2 to 1?
Downtown.
Downtown you get 2 to 1, and what downtown? Maybe in Jacksonville. Like, In Fort Lauderdale or?
Are you okay?
That's a good one.
In Jacksonville, no, in Miami, in most, you tend to get at most one to one, or less than 1 to 1, okay? 1 per 1,000 square feet, okay? So it's kind of interesting because this is kind of a CBD environment in Fort Lauderdale. She's got 2,000 square feet and she's actually got 5 parking spaces and a right to an additional parking space. Let me take a look at it. She's got a right to an additional parking space on a month-to-month basis, basically, okay, that the tenant can take back. Now, I'm kind of walking you through some of these things, okay? And, you know, so that's basically it, you know, signed it. She's got,
They rent so she rents the parking space per month.
yeah, typically that's one of the revenue streams in a,
Oh, wow.
in at least in a more urban or CBD office environment. In most suburban office deals, parking is part of the deal. And in suburban, you'll typically see, I'd say broadly 3 to 5 per 1,000. 4 is a good number to use in Florida. A lot of users like to see 5. That's an amenity that people usually use. And then depending on the use, you may need significantly more than that. So what do you see in a lot of, in here in South Florida, suburban office uses? Universities, you know, Kaisers and things like that. Call centers, NCL, Carnival. Those people tend to, because people work in small cubicles, they tend to require significantly more. They may need as much as 10 spots per 1,000. But then you get into a cost issue. Can you really, deliver that? So in that case, what actually works a lot of times is some of those uses can be alternate time uses. So you can have a suburban office building during the day where you give people 4 to 1 parking, and then at night, part of the space is Kaiser, and you can give those guys 10 to 1 because there's nobody else in the building at night. But you got to find a way to do it. You're making a commitment with all the tenants, right? If their uses overlap, you can't provide that. So just something to take a look at, okay? So how would you abstract this? So, I mean, there's no specific form. I'm going to use a form that Glenn worked on. And what they did was kind of I thought an interesting, they actually went and color-coded the tabs for each one of the modifications. So each one of the modifications, when you take a look at the abstract that they used, and I'll show you a little bit further below, they actually color-coded what some of the conditions were and tied them back to the lease modification. So, and I'll show you an example. So let's say we go to Allegues, which was the second tenant there alphabetically, and you jump to the most recent modification. 1 second, Maria. They actually color-coded.
Yeah.
Can you see it better now?
Yeah.
I'm going to blow it up a little bit.
Please.
Can you see that a little bit better?
Yeah, that works.
So you can see they actually color-coded the specific lines that they thought were important to abstract and tied it to a specific modification. So if anybody reviewing these abstracts later on had a question as to which modification or agreement along the way it came from, they could easily reference to that, right? So, ultimately this is the latest modification, so it's a 3-year period from 2012 on. The 1,700 square feet ties back to the second one when they must have gotten an expansion at that point, right? Because you read the original lease, you abstract it. Then every time there's a modification, you take that abstract and keep adding to it or modifying it, right? So you would find, just to jump ahead, there was an original lease, modification, third modification, okay? And so you're just adding on the conditions that happened, right? So, at the end of the day, there's no specific form for this, but you can see in their case, they wanted to know what operating expenses could be passed through. That's important in an office building, because we've said this before. What are operating expenses in an office building? In Florida, in a suburban, or I'm sorry, in a CBD office building in Florida, how much are they?
12 to 15.
We could say 12 to 15, that's a good number. What's net rents? Maybe 15, 16, 17, 18, 20, 22, $23. The point is, it's a significant component of the overall gross or full service rent. So you need to make sure that you understand what you can pass through, what you can't pass through, right? What are the uses that are permitted? And you ultimately get down to the important thing. What are you going to get paid per square foot? What are the parking spaces that you're going to charge? Again, as I said, 1 month a month, 5 that are actually ingrained, right? And then in this particular case, as I said, there were 3 months free rent that were passed through and $8,000 of TI. So in one spreadsheet, you can do this in a Word document, you can do it in a spreadsheet, but you take the key or important or principal conditions of a lease and summarize them in a way that's easy for you to review. And ultimately, you should be able to take this information and plug it into an Argus model if you're working with Argus, or plug it into an Excel model if you're working with Excel. So if you're building an Argus model, or somebody built an Argus model as part of the sales process and they gave it to you, it's the opportunity for you to go suite by suite and validate the in-place rents, the in-place terms, the increases that are permitted, the structure of the expense reimbursement, right? And ultimately, with your understanding of the market, for you to plug in the renewal probabilities at the time that the lease expires, so that ultimately you can build a prospective cash flow that can help you value what that building is worth. Make sense?
And this is just one tenant. So if you have multiple tenants, you go through this process.
Yeah, so I mean, if you look at this particular building, I think they've got about 30 tenants in there. You can see this first firm, Alemán Phillips Pavlov, has 7 modifications, and that's just one tenant. Allegues has 3. Burgos and Sosa have 2. You know, Damera and Greets, you know, so you just keep going. Look at all the tabs down below.
Every time there's a modification,
Well, a modification is like a new contract, right? So you've got an original contract, there's a modification to a contract. So some of the conditions by reference may continue, right? Subject to the modifications being outlined in this current contract, right? And so to really understand what legal rights and obligations you have and the tenant has with you, you need to be able to go through the entire history. This is actually a very time-consuming process. If you are looking at one building at a time, and your job is acquisitions, and you've got an acquisitions team, you may be able to do this on your own. In Glenn's case, he did this on his own. He went and sat there with the leases and read all the leases and all the modifications, right? We bought multiple buildings at one time. We got the leases in a box, and we sent them to Ackerman and had a bunch of junior attorneys look at them, because we just didn't have the horsepower to look at them. So, you know, again, I think as Nachi was saying, to the extent you can afford to rely on consultants who do this all the time, may be easier. To the extent that you're looking at leases all the time, I'm not an expert, I'm not an attorney, so I could look at a lease, and I think I could figure out a lot of the things in it. But, you know, as you can tell, it's very tedious, it's very time-consuming, but it's an important component of the diligence process, because it is the revenue stream that you are acquiring. And that revenue stream, you know, is all going to be different. You know, again, the easiest thing to do is get a single tenant building in a way, right? One lease to look at, and easy to understand. But, you know, in an environment where you've got multi-tenant spaces, it could be a very cumbersome process. Okay. So the assignment is going to be the team leaders, who I assigned as team leaders this time, have received, I'll tell you what they are right now. I might as well go ahead and tell you, because we're going to break up to do something else in a second, but Mark's not here, Alyssa, so you and Frederick, I'm going to have to, is Johnny didn't stick around this morning? I saw him this morning, he sort of left.
I said the same thing. Yeah.
He just,
Who is Johnny?
The tall skinny guy.
Oh, yeah, yeah.
okay, well, so Alyssa, you and Frederick are going to work with Mark, okay? Alex, Daryl, Tyler and Maria, you're gonna work together, but since Johnny's not here, and Mark's not here, I'm gonna switch one of you. Dylan, Nicola, and Robert are gonna work together. Dustin, Michael, and Juan are gonna work together, okay? And, I've sent the different folders, so Burgos Sosa, your leaders have it, so don't worry about that. So the at-home assignment this week is your team leader has received a folder from me with the leases and all the modifications for a specific tenant in this building. And the leader has also received a blank template, just like this one, okay, for you to fill out and abstract the leases. So your assignment this week is to take a lease folder and make an abstract. So at the end of the day, somebody can come in and plug that into an Argus model and figure out how we're going to value this building. Yes, Maria?
The Argus model that they use to structure these is what type of Argus?
Well, I don't know if he used DCF or if he used something else. That's not part of this assignment. How badly do you want to know?
No, it's fine. I'm gonna get up.
I mean, if you want to know, well, you can't look it up because you don't have it. If you want to see, I can't see it here because there's no Argus loaded here. I just have the Excel dump.
It'll be, it usually shows on the Excel file.
Will it?
Yeah.
DCF.
Oh, yeah.
Okay, so,
Man, I should
but
That's great.
that's not part of this assignment, okay? Now, so that's one assignment. We've just prepared that, right? Now I'm going to change the perspective for what we're going to do in class today in groups. So, for next class, lease abstract. What we're going to do today is last week, so when Nachi broke up in his particular way, the way they looked at buildings, there was an economic component, there was a physical component, there was a legal component, and there was a market component. When you think of market, there are two key market metrics that we need to understand. One is the lease rate. What is the ongoing revenue stream that we need? The second one is, and some of you started migrating to that last week, is what's the market valuing this building at? So again, without being appraisers, there is a market expectation for pricing on buildings. And that expectation depends on the type of asset, the way we quote it, right? We typically harmonize all this by talking about cap rates. So the one way to sort of universally compare assets, because each asset is unique, is to say, what's it trading at? What cap rate is it trading at, right? So, hey, that office building is trading at a 7 cap. And from that relative valuation perspective, we can say it's high, it's low, it's at market. Another way that we can also measure that is a sort of price per pound, right? That building is trading at $500 a square foot or $100 a square foot. So these are metrics that help us understand whether the value or the structure is appropriate or where the market is valuing it, okay? Yes, Robert?
I've heard the term quite often over these two terms, so I still haven't gotten a full grasp of what we're talking about when we talk cap rates. Now, I have the basic understanding, but why is it so important?
Okay, so I'm going to broadly define cap rate as anything you want it to be, right? But it's a stream of income that is capitalized, okay? So roughly, it is a measure of income over a measure of value. Okay, now, in the context of diligence and in the context of an acquisition, cap rate refers to the in-place NOI. So what is the net operating income of the building today? And value refers to the purchase price or the acquisition price.
But the concept is really universal. At any given point in time, any asset has a capitalization rate. So, let's not use the AutoNation building, the one next to it, right? That building has a cap rate. It may not be on the market, but there is an income stream associated with it, right? And there is a market value. So, it could be owned at, today it could be at an 8 cap. That could be what, the value of that building is, okay? You say, do people use it outside of a transactional period? Not often. But where I can tell you people do use it is, I know, for example, there's a firm called Green Street Advisors which tracks REITs. One of the way that they try to value the stock of some of these REITs is by trying to figure out or guesstimate what the cap rate is at any given point in time for the assets that are owned by the REIT. Okay, so generally speaking, and specifically in this class, when we talk about cap rate, we're strictly talking about the in-place income stream, net income stream, over the value or the acquisition price. Why is that important? It is the relative value of that asset and compared to similar values. Real estate assets, by definition, are all unique. You can build this exact building 3 miles from here, and it's not the same real estate asset, right? What did we talk about that building in Jacksonville? What's it worth? $100 a square foot. That building, that same building in Miami is worth $300 a square foot, and $300 a square foot in Fort Lauderdale, and maybe even $400 in downtown West Palm Beach. So real estate by its essence is all different. And so the cap rate allows us to provide a relative valuation. It's very similar to the concept of price earnings with stocks, right? People are always trying to benchmark. Am I good? Am I bad? How do I compare or stack up compared to other people? So people talk about the price earnings ratio in stocks and say, hey, it's cheap or it's expensive. Hey, Coke's trading at 16. Is that high or low? Well, what's Pepsi trading at? Right? They're totally different companies. Right? I mean, one's got food service, but they're similar. I mean, you're going to say, well, Pepsi's trading at 80 and Coke's trading at 40. But those aren't relative to one another because there's a different number of shares outstanding, right? So the way to kind of ultimately reduce it is to come back and say, okay, for every share that's outstanding, how expensive is this versus its income stream versus this one? And that's what you're doing with real estate. When you use cap rates, you say, hey, that guy wants to sell a building and he's put a price on it. He's put a price of $50 million on it. Okay? Right? And the net income on it is $2.5 million. What's the cap rate that he's asking for? Is that 5%? 5 million would be 10%, right? So let's assume it's... Who's got a calculator?
That's 2.5.
Yep, 2.5.
Well, my question on that is, do you want high or you want low?
Well, yeah, I mean, you want to buy low and sell high, right? I mean, isn't that the way it always works? You want to buy low and sell high. Alex, 2.5? I'm sorry, 5?
Oh, yeah, I got it, 5.
2.5 divided by 5 is
5%.
Is a 5% cap rate, right? So all of a sudden, you don't have to go that far, right? So, hey, are you interested in that building, Robert? What's the cap rate? 5%. Not interested. Glenn brought me a deal the other day. So now this is...
Is that considered buying high?
Yeah. How do I know that that's high? Because I can compare it to something else. Glenn brought me a building the other day. And he goes, hey, professor, let's buy something together. Okay, Glenn. So he says, I like the building. I actually like the building. Then make a small world. Not you looked at the building before. So what's my first question to him? What are they asking? Oh, they're asking $10 million. I don't care what they're asking. What's the cap rate? Oh, it's like, 4.53%. Forget it. Not interested. Well, what level would you be interested? Okay, let's play with the cash flow. Let's get it up to about an 8 cap. Right? How do you get it there? Okay, well, let's play around with leverage. Well, 8 cap, no. Let's play around with the price per square foot, and let's get the price. So instead of 10 million, they want 7.5 million. Okay, 7.5 million. The NOI doesn't change. Now the cap rate's whatever, 8. Wow, that sounds good. Okay, what's the IRR I'm going to get on it? Okay, now let's play with leverage, and let's play with reversion, and a series of other variables. But cap rate is probably the single most valuable indicator of comparison between assets and real estate at a particular point in time.
But in that case, it sounds like you want to buy at a high cap rate and sell at a lower one.
Well, you typically would want, for IRR purposes, there's an arbitrage to be played, right, by buying at a higher cap rate and selling at a lower.
Okay.
And conversely, there is a risk to buying at a low cap rate and selling at a high. And you say, do you control that? What was the question that I asked when we were talking about interest rates before?
Does decrease in
So the decrease in interest rates
have a relationship on cap rates.
Right, and we've shown that. We've shown that, right? If you don't believe that, I've shown this in the capital markets class. If you don't believe that, hold on, let me go to the graphs. If you don't believe that, I wasn't going to show this or focus on it, but there is definitely a relationship that exists between cap rates, okay, and treasuries. Now, there are compressions and there are expansions, but there is definitely a relationship that exists, okay? And so, if interest rates go down and there's a consequent reduction in cap rates, right, and interest rates are at historical lows, right, the most basic diligence question of all at a macroeconomic level is, what's the direction of interest rates today? Because if I buy a building at a 7 cap today, or at a 5 cap, and treasuries are trading at 2%, okay, this is at the end of 2013, so they've actually come down a little bit. If treasuries are trading 2%, and those are 50-year lows, what's the tendency of interest rates in the long term? They're going to go up. And if interest rates go up, cap rates are going to go up, which means what you're paying for today, you're going to sell at a lower relative value in the future. And so what's that going to do to your return? Or like wipe you out, you know?
Right.
Or wipe you out. So, one doesn't want huge volatility in interest rates. I'm not necessarily predicting that. I'm just saying we will have inflation in this country at some point. I don't know when. But somebody's going to say we didn't see it coming. We've seen it coming for 10 years now. We cannot continue to have the deficit spending that we have without a consequent increase in inflation. Paying for something with borrowed money ultimately has the implication of purchasing power loss or degradation. So, whether it's this year, whether it's next year, whether it's 3 years from now, there will be inflation. Inflation will bring interest rates higher, okay? And with higher interest rates will come higher cap rates, and with higher cap rates, you're going to see decreased relative valuation, which means what you pay for today very dearly, you're going to sell at a lower relative value in the future. Dustin?
So with that argument, why wouldn't anybody buy an office building today?
Yeah, that's the question that I would ask. That's a great...
5 to 10 year hold period.
Yeah, so I think maybe it was in another class I said this once, but...
Assuming, I guess, that rents are going to increase.
Right, well...
But there's still a big spread if we're at 2% on treasuries, and you're buying a 4.5% in that example cap rate. There's very little.
No, there's very little
risk premium to that building.
So the question is, the answer is the following. Everyone will find a justification for why they should buy. Okay? At a very basic level, I will give you the example in a fund like Nachi's, which is a family and friends fund. To not minimize the significance, the last asset that was purchased was a $60, $70 million asset. It is a significant, fund. They're actually tapping out on fund 2, so it'll be a third fund coming out. So even within the context of a fund like that, what you look for is very long-term hold period. So, last building, institutional mortgage, fixed rates, okay, 10-year money, okay, and a 10-year hold. So the perspective is, listen, we don't really care. We've got current income as a significant component of our return over time because we've got positive financial leverage, and we anticipate that rents will grow as inflation goes up, and we'll be able to pick the right time to sell. We don't have any one particular lease that creates a problem in a particular year. So we've got multiple multi-tenant leases, right, expiring at different times, right? And so it's a very long-term hold perspective without having the gun to your head saying, I got to get out, okay? That's one justification. Another justification is the one of saying, hey, listen, we're going to hold it so long that it's worth the dirt it's built on. So if I can't find a buyer for the building in 10 years, I can always knock it down and redevelop at that point based on the economics of that point, okay? I'm going to be more cynical. Most institutional real estate in this country is not traded for any of those reasons. It's traded because people get paid to put other people's money to work. And they don't care. And I'll share a personal anecdote. 2003, 2004, I made a presentation in front of a group called REE, the National Association of Real Estate Investment Managers. And it was on turning around, it was the turnaround of the trade zone and how we did it. Sit down at dinner afterwards, I had a guy next to me from ING. And at that time, ING was heavily invested in multifamily. So this 2003, interest rates weren't where, you know, they ultimately came down to something. And I said to the guy, because I didn't know anything about multifamily, I said, where are multifamily assets trading at here in Florida? I said, are they down into the fives? And he said, I wish. He said, we haven't seen 5% for a quality asset down here in at least a year. He said, we're in the fours. And I said, well, how can you buy that? And he goes, because personally, I don't care. I'm not going to be around in 10 years when they sell it.
Oh.
And but it's a real life story.
Yeah.
He got paid to buy stuff. And it was, I'm not going to be around, so. Now, how do you pencil it? You hold cap rates, exit cap rates steady. This office building we looked at, that Glenn brought me the other day, they were going in at a 4.5 cap, and they were selling it like, their justification for their $10 million purchase price was, you buy it at a 4.3 and you get out at a 4.3 in 10 years. I mean, how can you really envision that 10 years from now you're going to have office cap rates at that level? It's crazy, but some people will believe it. I could tell you that in our development realm, right? So developers tend to be very optimistic, very aggressive people by temperament. Go as a conversation. Am I an accountant because of my temperament, or is my temperament because I'm an accountant? I'm not really sure, but there's definitely some sort of relationship there. Developers have to believe that they can pay $57 million for a 2.5 acre piece of land, even if it doesn't pencil out. I know a developer in this room who just made an offer for something that I would have never offered for a piece of land somewhere, when I don't think it pencils out. But I'm the accountant. There's a developer that believes it, right? And in a lot of development models I've seen over time, people have very liberal assumptions. So somebody is assuming that rents are going to go up, by whatever, that cap rates aren't going to move. In a lot of cases, that you're going to be able to refinance debt at very, unrealistic levels or optimistic levels, that you're going to be able to sell units at a certain price, and some people guess right, make a lot of money, and some people guess wrong and lose a lot of money. And that's a development business. There's not a lot of people that hit singles in development, man. In development, people make a lot of money or lose $400 million bucks. So, but it's tough. Dustin, I will tell you, unless you have a very long-term perspective on real estate, unless you have very patient capital, and unless you can properly create a positive financial leverage environment for a long term in which current income composes a significant component of your overall return, I think it's a tough sell. You know, I did a thing in a cap markets class on what should your theoretical return be comprised of in an asset. Should it be capital appreciation or should it be current income? And obviously that's going to depend on your style. We've talked about different styles, right? And we've talked about core, where it should probably be a significantly higher component. And we talked about opportunity on the other end, in which current income is typically not any part of your return, right? In a REIT world, which is where you get information, if you look at a 15-year period, 60% of the overall return with REITs is current income. And I'm going to, define like most, I think most standards, REITs are going to be core, maybe core plus type players. And so if in that realm, they're saying, hey, the overall return by default is 60% current income. If you can get yourself into an asset where 60% of your income you're getting along the way, you're going to shield yourself somewhat from degradation in value because of cap rate inversion. Okay? Now, I digressed a little bit, but I thought it was an important point.
What happened in 2006? Did you just believe that maybe that part of the NASDAQ just being overvalued and then moving your people moving to real estate? Because it looks to me that may be one compression.
Oh, I mean, listen. So remember, there are leading indicators and there are trailing indicators, right? There are things that tell us things are going to happen, right? So let me give you an example. People talk about relationships between high grade and low grade debt.